Hello everyone. Today let's talk about treasury. So beginning with the very basic question that what is treasury? Uh, Treasury is the department of an organization that relates or pertains the management of finances of an organization. Right? By the management of finances, I mean to say that the revenues, the management of revenues, payments, investments, cash flows that are being generated, hedging, everything related to cash or everything related to finance is would come under the activity or the responsibility of treasury. Now, treasury operations are streamlined in two ways. The first one is centralized treasury management system. Second one would be decentralized treasury management system. So let's dive deep into them and understand exactly what is centralized and decentralized treasury. Beginning with the decentralized treasury. So decentralized treasury operations majorly refers to financial management and control processes that are fragmented. By fragmented, I mean that each individual unit or each individual segment, each individual subsidiary, each individual department would be responsible for their own finances, would be managing their own finance. Right? So benefits of this treasury system would be number one, flexibility. Right? When the finances are being managed at local level by the subsidiary owned by that particular subsidiary, they are managing their own finances. They would know the market conditions, and due to that knowledge, they would be able to invest more effectively, more in their favor. Like they know when the market is going to favor them, and they invest strategically at that moment, which is not the case with the other. That's why they have a flexibility of investing according to the market trends. Second one is in line with the first one, which says proximity and knowledge of local markets. As I said that each subsidiary or each unit is managing their own finances. So they are in a close proximity to the local market and they have a great knowledge about the market and what's happening in the market, what can happen, what are the potential risks in the local market. So according to that, they invest more strategically, which gives them an edge. Third one is better idea of local banks. Actually, when in both the treasury, like in both treasury management systems, be it decentralized, be it centralized, the subsidiaries or any unit that is managing the finances, they maintain a banking relationship with multiple banks, right? So when I talk about a better idea of local banks, I mean to say that each, for example, let's say subsidiary, each subsidiary that is operating in different units, firstly, it would be termed as regional treasury center. Right? Each subsidiaries that is operating in different regions, in each subsidiary that is operating in different regions would be termed as regional treasury center. Right? So that regional treasury center would be going the transaction charges, the bank charges that each and every bank offers locally. So they have a better idea of the local banks. It eventually allows them to maintain banking relationship with those banks that offer them lesser banking charges, that offer them lesser transaction cost, which eventually leads to reduction in the overall banking charges of the company that favors the company. Right? So they have a better idea of local banks, which helps them to maintain more strategic relationship with the banks. Number four and the last one would be satisfaction of employees. So when employees are involved in the management of finances, like they are involved in the managing the cash flows and they are responsible for the revenue or cash flows generated, it inculcates a sense of satisfaction and that they are important to the organization and they play a great role in the company, due to which it motivates them and it provides satisfaction to them. And we all know that satisfaction and motivation of employees is directly related to the output. So yes, these are some of the benefits of decentralized treasury. Now let's move on to centralized treasury. Uh, as the name suggests, it involves the establishment of a central treasury head, or you can say central treasury department, in a particular region, which is held responsible for managing the finances of each and every fragmented unit of an organization, be it departments, be it any unit, be it subsidiaries. All the responsibility of managing finances are held onto the centralized treasury head. Now, this is the centralized treasury management system, which basically involves the establishment of a central treasury head that is held responsible to manage the finances of each and every unit of the organization. Now, talking about the benefits, the first benefit would be improved cash management. By cash management, I mean to say that it leads to greater cash visibility. Now, cash visibility, what is cash visibility? Actually, in centralized treasury management system, uh, when the centralized treasury head is established, all the funds, all the revenues, all the cash flows that are being generated by each and every unit is pooled in the centralized treasury head, and that centralized treasury head then allocates the funds accordingly, according to the needs of each and every unit, right? So they can track from where is the revenue coming, from where the revenue is from, where is the revenue going to where the revenue is going, and this complete cash visibility leads to effective cash management. So this is improves cash management. Second one, less cost of return. Let's take an example. Uh, let's consider an organization XYZ or ABC. Let's take XYZ with five subsidiaries. Each and every subsidiaries requires a debt of $10 million. Right? In this example, we'll consider both the treasury management systems, decentralized as well as centralized. Firstly, talking about centralized or decentralized management system. In decentralized one, what would happen is each and every subsidiaries would go to the bank and procure loan individually worth $10 million each. This would lead to five debts of $10 million each that the bank would give them at a higher rate of interest. Why? Because the amount is terminated, amount is lower. And as compared to that, when we talk about centralized treasury management system, in centralized management treasury system, now, what would happen is the requirement of $10 million each of each and every subsidiaries would be communicated with the centralized treasury head, and the centralized treasury head would lead to procurement of the whole amount that is required by all of its subsidiaries, which comes to $50 million. $10 million requirement of each subsidiaries and total five subsidiaries, which comes out to $50 million of debt. This $50 million of debt would be procured by the centralized treasury head at a lower rate of interest. Why? Because the loan is in totality, the loan amount is high, and higher amount of loan charges lesser rate of interest. So this difference in the percentage of interest leads to lesser cost of debt. Right. The third one is multilateral netting. It's a bit difficult to understand if I just cite out the definition. So let's dive into an example to understand it better. So here is the example in front of you. Consider a situation where an organization has two subsidiaries, and in subsidiary one, it has to pay $100 million in 6 months. Talking about the second subsidiary, it has to receive $100 million in 6 months. Now, under decentralized management system, what would happen is the subsidiary one, which has to pay $100 million in 6 months, would hedge with short functional currency forward or long functional currency forward. Now, before moving on ahead with the example, let's understand what is hedging and what is hedging with short and long functional currency forward. So first talking about hedging. Hedging is like an insurance. Uh, like an insurance, you reduce your potential risk. Same goes with hedging. Hedging refers to that strategy which you use to reduce your potential risks, right? Now, hedging with short functional currency forward or long functional currency forward, what is it? So first talking about hedging with short functional currency forward. Firstly understand what is functional currency. Functional currency is the currency that the organization usually deal in. In our example, it is dollar, right? So when we talk about hedging with short functional currency forward, it refers to the situation where the organization has an expectation that its currency would be weaker in future. The currency, by the weakening of currency, I mean to say that the currency would be weakened in the future, which means that the exchange rate would go down, right? So what exactly the organization will do in such situation when they expect that their currency would be weakening in the future? What they will do is that they'll enter into an agreement with the third party where they would be selling $100 million or any other amount that they agree upon. They would sell some amount of dollars at an rate agreed upon today after 6 months. So what exactly would happen is now, suppose the company expects that the currency would be weakened, currency would be weaker in future. They enter into an agreement to sell certain amount of dollars at an exchange rate agreed upon today after 6 months, and exactly same happens. The currency gets weaker, the exchange rate goes down after 6 months. Now the company would be able to sell their currency at the rate that is agreed upon today, which is higher than the current market, which is higher than the market rate at after 6 months, and the company would gain, right? So they have hedged their risk, that which was exchange rate risk in this case. They have hedged with the strategy by selling the agreed amount of currency at an exchange rate which is higher than the current exchange rate after 6 months. So this is hedging with short functional currency forward. And vice versa, if I talk about the long functional currency forward, in this case, the company expects that their functional currency, the exchange rate, or the exchange rate would go up. Their functional currency would become stronger, right? Which means that their functional currency would become expensive. So in this case, they enter into an agreement that they'll buy certain amount of currency at a rate agreed upon today, and they'll buy it at a rate of agreed upon today. So if in reality also, if the market condition favors the expectations of the company and the currency, their functional currency, which is dollar, actually gets stronger in future, actually it becomes more expensive in future, what will happen is that they will be able to procure that said amount of dollars at an exchange rate which is lower than the exchange rate after 6 months. So they would gain in this case, and this is long functional currency for them. So you can clearly see that in the decentralized management system, no, they have to hedge they have to hedge this amount of $100 million in order to reduce their exchange rate risk. They have to imply strategies, they have to hedge it, they have to do a lot of things to reduce their potential exchange rate risk. But in centralized management, there is no need to do anything. Why? Because the duration of 6 months is equal and the amount, which is $100 million, they both would offset each other, because in the first case with subsidiary one, they are paying $100 million in 6 months. In subsidiary two, they are receiving at the same amount at the same after same time. So they both will cancel out each other, and their duration, which is 6 months, and the exposure that is $100 million would offset each other, and no action would be taken. So this particular act is known as netting. The transaction of $100 million of paying $100 million with subsidiary one, and the case of receiving $100 million after 6 months with subsidiary two. They both offset each other, they both net each other, which is known as multilateral net. So this is another advantage of centralized treasury, which is not in the case with the decentralized one. So now coming on to the fourth one, better banking relationships. Now, in decentralized one, we discussed that each and every regional treasury center would be dealing with multiple banks according to their benefit, according to the transaction charges that they are being offered by the banks. Actually, what happens in centralized treasury, na, the centralized treasury head has to maintain relationship with different banks. It is similar to that case where, say, decentralized one with each subsidiary, they have to maintain banking relationship. Similar to that, the centralized treasury head would also maintain relationship with banks. But in this case, what would happen now? When we are talking that each unit of the organization is maintaining individual relationship with the banks, and when we are talking that a single centralized treasury head is maintaining relationship with the banks, firstly, what would happen is the centralized treasury head would have more amount of funds, right? Because all the funds of each and every unit or each and every subsidiary of each and every department is pooled at the central treasury head. So what would happen is they would have a significant amount of business that they can give to the banks, which would lead them to better relationship with the banks, because even the banks would not be willing to just let go the amount of business that they are getting by the organization, right? So in this case, they are able to maintain better banking relationships, and it gives them the negotiation power to reduce the banking charges to a considerable extent. Because the bank, as I said earlier, the bank also doesn't want to let go the opportunity or the amount of business that they are getting from a particular organization. So this centralized treasury head allows them to have better banking relationships with each other. Last one, fifth one is intercorporate deposits. So intercorporate deposits. So let's understand this with an example. Here is your example of intercorporate deposits. Let's take a situation where an organization has four subsidiaries in total, subsidiary A, B, C, and D. The current situation of each and every subsidiary is listed in the table, which says that subsidiary A is currently is cash surplus or worth $14 million. Subsidiary B is in the situation of cash deficit with $19 million. Subsidiary C with $23 million of surplus, and subsidiary D with $12 million of cash deficit. In totality, if we talk about the total cash surplus of the organization is $37 million, and the total cash deficit is $31 million. Now, the what in general sense, in decentralized case, what company would do, the each and every subsidiary would like, for example, if we talk about subsidiary A in decentralized one, I'm talking about right now. Subsidiary A would invest this cash surplus. Subsidiary B would procure a loan or procure a debt. Subsidiary C would again invest their cash surplus, and subsidiary D would procure a debt for their cash deficit. Now, all these activities would be conducted in the case of decentralized trading. But what would happen in centralized trading? Subsidiary A's cash surplus and subsidiary C's cash surplus would be pooled in the centralized treasury head, and that centralized treasury head can allocate those pooled funds among subsidiary B and subsidiary D, which would save their debt cost of debt. How? Let's understand this. Uh, on the right to the arrow, we can see that subsidiary A can allocate, then they can grant $5 million of loan to subsidiary B and $7 million of loan to subsidiary D. Same goes with subsidiary C, which is in cash surplus. They can allocate their funds to B and D in order to reduce their cash deficit onto zero, which nullifies their need to procure a debt from the bank, which would be definitely be issued at a higher rate of interest. And in this case, it is not that the debt would be free, right? Intercorporate deposit means the allocation of cash surplus of some subsidiaries among the other subsidiaries that are in the situation of cash deficit or they require debt. So in this case, the subsidiaries B and D that are procuring debt from subsidiary A and C, they can give them an interest rate of 6% per annum, which is lower than the bank rate, which is 8% per annum in our example. And this would save a lot of cost for the overall organization, as well as it would allow them to to earn some interest as well on the allocated funds. Right. So this favors the overall organization by eventually reducing the transaction overall reducing the bank charges, the cost of debt basically, and it also at the same time it also helps to earn some amount of interest as their interest expenses, which is definitely lower than the bank rate of 8%. So this is intercorporate deposits where internally the funds are allocated among those subsidiaries or those departments which are in the situation of which are in the need of debt. It reduces the cost of debt and makes earning opportunities for the subsidiaries with cash surplus. So these are the potential benefits of centralized treasury that pertain to the centralized treasury management system. Now, concluding, basically it depends upon the discretion of the company to choose among the decentralized or centralized treasury operation. It depends upon the needs of the company, but talking generally, companies that have a strong global presence with multiple subsidiaries operating in vast, diverse spread of regions, and they when which have a strong global market, strong global presence, they generally prefer centralized treasury management because, as I said earlier, large number of subsidiaries would eventually lead to large number of transactions, which eventually increases the cost of transaction, which increases the cost of bank charges, which is lowered by the centralized treasury management system if followed. So, in general sense, or generally, the organization which are operating at a very large scale, they prefer centralized treasury management more. Overall, it depends upon their discretion, but in general sense, they prefer central treasury management system more. As well as if I talk about decentralized treasury management system, it is generally preferred more by small organizations or those organizations which are not operating in very diverse regions. They are operating in close proximity to each other. Irrespective of the scale, they are not spread in vast regions. They are concentrated to a particular region and they are operating there. In such type of organization, decentralized treasury management system is generally preferred. But again, at the end, it depends upon the decision of the company to choose among the decentralized or centralized treasury operation. So by this, we come to our end of studying about or learning about what is treasury. In a crux, we learned about what is treasury, what types of treasury companies generally follow, in which we learned about decentralized treasury management system and centralized treasury management system, along with some of their examples, as well as we understood some difficult terms like multilateral netting in easier way and intercorporate deposits and hedging with short and long-term functional currency forward. So in crux, we learned about treasury and all these. Thank you for being with me. Thank you so much.